1 year ago, I invested $10,000 into QQQM, the NASDAQ 100 ETF. Today, I'm revealing the unvarnished truth about its performance over 12 months. We'll explore the market's unpredictable highs, stomach-churning lows, and every critical lesson learned. Was this a brilliant move or a costly mistake? Stick around for my honest, complete breakdown. My investment strategy always starts with clear objectives. For this $10,000, my goal was direct exposure to the formidable growth-oriented companies dominating the NASDAQ 100 index. I chose QQQM, the Invesco NASDAQ 100 Mid-Cap ETF, over QQQ, primarily for its slightly lower expense ratio. This small difference can yield significant long-term returns. QQQM meticulously tracks the same index, embodying technological innovation and market leadership, making it an attractive option for aggressive long-term capital appreciation. This was a strategic allocation designed to add concentrated growth to my broader portfolio. My aim wasn't just profit, it was also to observe how a focused growth play performs through diverse market conditions. While individual tech stocks were considered, QQQM's inherent diversification across 100 leading companies offered a safer, more robust approach, mitigating single-stock risk while still capturing major sector movements. This informed decision anchored my investment. Initiating this $10,000 investment involved a crucial first step: consolidating funds. I visited my local commercial bank, a solid brick-and-mortar establishment. The clear, professionally branded bank signage was prominently displayed above the main entrance doors. To my right, an accessible ATM hummed. Discreet security cameras silently monitored the professional financial environment. The cool, gray concrete pavement felt distinctly firm underfoot as I stepped inside. My task was simple: transfer funds from my traditional low-yield savings account directly into my online brokerage. This symbolic yet practical act moved capital from a stagnant environment to a dynamic, high-growth investment vehicle. There was a mix of anticipation and a slight tremor of uncertainty as I finally navigated to my brokerage platform, located QQQM, and clicked the pivotal Buy button, irrevocably committing $10,000 to its purpose. It was a defining moment of financial commitment, putting capital to work. The subsequent 12 months were anything but linear. Global markets, especially the technology sector, experienced a roller coaster of sentiment and economic pressures. We witnessed significant market corrections, then strong rebounds. Initially, my QQQM investment dipped, mirroring broader tech concerns driven by inflation fears and rising interest rates. I saw considerable red numbers, genuinely testing my conviction. However, as interest rate hike narratives softened and AI excitement surged, QQQM began its impressive upward climb. I diligently observed key market data daily, noting critical economic indicators and corporate earnings reports, profoundly influencing the ETF's trajectory. It was not a smooth path, rather distinct peaks and deep valleys characterized the journey, with sharp drops often followed by steady recoveries. Understanding this market ebb and flow is crucial for any investor, especially when committing $10,000. This period was a masterclass in market dynamics. So, after 365 days of observation, analysis, and market drama, what's the definitive verdict? The moment of truth has arrived. My initial $10,000 investment in QQQM is now proudly worth an impressive $12,350. This represents a total cash gain of precisely $2,350, translating to a remarkably healthy 23.5% return on investment over the 12-month period. To provide context, this significantly outperformed the broader S&P 500 during the same time frame, which yielded approximately 15%. I am genuinely pleased with these tangible results. This outcome isn't just about the monetary figure, it's confirmation that strategic, patient investing in high-quality, diversified growth assets can indeed yield substantial returns, even in a volatile market. The magic of compounding, even over a single year, is undeniably potent.
I also consistently reinvested all dividends received, however small, subtly yet effectively contributing to this overall capital appreciation and growth. This result offers a compelling case study for patient investing. Beyond the satisfying monetary gain, this year-long investment with QQQM reinforced several invaluable, timeless investing principles. Firstly, patience is paramount. During significant dips, the temptation to sell was strong, but holding firm paid off. Secondly, deep understanding of your investment is key. Knowing QQQM tracked the NASDAQ 100, composed of strong, innovative companies, provided confidence to weather market storms. Thirdly, diversification, even within an ETF, provides an essential cushion against single-stock risk. Had I chosen single tech stocks, outcomes could have been drastically different. Finally, consistent, non-obsessive portfolio review is critical. Daily fluctuations are noise. The long-term trend truly matters for sustainable wealth accumulation. This experience solidifies my profound belief in exchange-traded funds, particularly those tracking major indices, as incredibly powerful, efficient tools for achieving targeted market exposure without incurring disproportionate single-stock risk. It's about smart, diversified exposure for strategic growth.